And so a lot of what we do, at Level, it really has a network-centric lens. And so part of what we do in a lot of the core data sets, besides your sort of traditional machine learning, is we're always reconstructing networks or patterns of relationships between different entities. You can think of it like a large knowledge graph.
Hello, everyone. This is the One Point Podcast, and I'm Rohit Yadav. We recently released a comprehensive ecosystem wide report called Rethinking Venture Capital, a Strategic Lens, in which we explore the entire value chain of venture asset class. Now, within this overarching strategic report, fund of fund was a very prominent theme. And today I'm just extending this discussion with Albert Azout from Level VC. He's twice exited founder, started his career at Lehman as a software engineer and as a technology analyst. He was a GP at Kota Capital and then transitioned into a venture partner role alongside starting Level in 2021. What I absolutely love about him is his extreme focus on data, research within investing. And you can read all about it in his Level VC blog. So, Albert, thank you for joining us.
Thank you for having me.
So, the first question, what is Level VC?
We started the firm in 2021, and the idea was really to rethink the LP-GP equation in the ecosystem. And we felt that there was an opportunity because there was more and more data coming online, and there was this continual changing guard in terms of the GPs out there and just the dynamics around venture, that there was an opportunity to take a data lens, but also to develop a new kinds of relationships between GPs. So Level really has a few parts of its platform. We have a fund of funds structure. What we do there is we invest in emerging VCs. Typically, what that means for us is fund target sizes that are under 100 million, pre-seed and seed focused. We also like funds that are smaller. So typically the average size is around 40. What we do is we try to take a large LP commitment, take a lot of conviction, help in a variety of different areas, including capital formation. So that's the fund strategy. We also have a co-investment strategy. And the idea there is to provide more capital to the GPs into companies that we believe are generational. And so we have a co-investment arm that focuses mostly on Series B investing, sometimes like a pre-B round as well. And then the third piece of what we do is really the technology piece. Our team is mostly data scientists and engineers. I believe we've developed one of the more advanced systems in the market, but what we do is we ingest terabytes of data across many different sources. And there's really three things that we do with it. One is we use it to make decisions on GPs. And we do that by trying to get early signal on the embedded networks that GPs have, both in terms of co-investors and talent. I can talk more about that. The second thing that we do is really track the whole market. And really focus on which thematic areas we want to focus on, but then also which companies, and specifically which companies in our look-through portfolio for co-investing. So there's a whole motion that we have around co-investing and using technology to do that. And then the third piece is really adding value to GPs. And so in a variety of our GPs in our portfolio, we provide them with all kinds of stuff. So tooling, for example, for advanced network search, or for enriching their CRMs, or for delivering them data that can help them in sourcing or portfolio support. And so over time, we expect that to be a big part of what we do is provide a technology value add in addition to the other things that we do. So that's a high level. We're operating out of our second fund, which we started in January, and are about 15% of the way deployed on that fund.
Okay, awesome. I think you covered a lot of ground. So let me just unpack it. Why do you focus on fund of fund model as well as co-investments in which you go direct investing in startups?
I think, we also do a little bit of LP secondaries as well. So I think for this part of the market, especially because the length and the duration of the investments that you make, especially in a fund of funds where there's three vintages, the funds take a while to deploy and to return capital. Obviously, DPI has been suppressed, and also the companies are staying private longer. So we think it's important to have a mix between having a diversified seed fund strategy, but also layering in high convexity potential co-investing as a way to compress the J curve, in addition to having more opportunistic kind of LP secondary. So we think it's important to have a mix in order to be able to manage both liquidity as well as returns for LPs. So that's the idea.
And if it's openly available, and if you're ready to share, like what part of that is fund of fund and what part of that is direct investing in secondaries?
Yeah, today it's around 80% is fund or LP kind of secondary, LP led or GP led secondary sort of opportunities. That's like fund investing. And then the 20% is co-investing today, although we think that'll grow over time.
Okay, so the second part of co-investing will grow over time.
Yeah, we believe so. We see enough opportunities, of course, as the underlying portfolios grow, and whatnot. We'll just see more opportunities, and so we think that that can grow. And as we get our more of a brand moat on the co-investing side, we think there'll be more opportunities for more
Okay,
investment.
got it. So for the second question, I want to touch upon one of the points that you mentioned already, that you try to use data to evaluate the themes. So tell us about the background of starting level and how you thought about utilizing this data, and maybe also capture some of the highlights within your portfolio.
Yeah, sounds good. We, philosophically speaking, the way we've thought about this, and a lot of the research actually comes from complexity theory, which is really focused around understanding, large scale real world networks. And so a lot of what we do, at level, it really has a network centric lens. And so part of what we do in a lot of the core data sets, besides your sort of traditional machine learning, is we're always reconstructing networks or patterns of relationships between different entities. You can think of it like a large knowledge graph. The key ones that we think are for the ecosystem of venture is this sort of patterns of relationships between investors, right, which are focused in time, right, because there's staged investments in venture, and so people come in at different times, different firms come at different times.
Yep.
And then the other one is talent networks, right? It's trying to figure out which are the founders and how are they related and who has access to what founders. So I just mentioned that a lot of what we think about is not just looking at a firm in a vacuum, or a GP in a vacuum, or an angel for that matter in a vacuum, but looking at the ecosystem in which they're embedded. And the reason is because where you're embedded actually does impact a potential performance, because networks are by definition asymmetric and not everybody has access to the same networks. And so that's the lens at which we look at the world, and we've built a bunch of primitives around that in order to enable us to make decisions. And so you can think of our system as having, there's predictive components which try to predict performance per se and have some confidence. There's more of like decision support, explainability modules, and trying to understand different features of the GPs or the companies. And then there's more of like just analytics. And yeah, I'm happy to talk more about that, but that's sort of the philosophy of what we do. And then of course it's not a purely a quantitative shop. And so there's a human component. And the way we've thought about it is, how do we increase speed and productivity in decision making? And that is a function of both filtering opportunities quickly, but also diligencing things in such a way that you can get to conclusions really, really quickly. Because in our business, especially because where we're situated in the market, speed is basically everything. And so a lot of what we do is focus around automation and efficiency.
Okay, so your background is very data driven, analytical, right? So when you started Level, the thought process was that you are going to use the mathematics, the data, and the analytical skills that you possess to develop fund-of-fund model and apply that to a fund-of-fund model, right? So that was the real beginning and the background of Level, if I understood correctly.
Yes. We felt that the best place to start from a structural perspective is a fund of funds, because you get access. Not only do you meet many funds, and obviously you look at their data rooms. There's a lot of data flow coming from the fund of funds market that hasn't been leveraged, and it gives you a very interesting structural position in the market when it comes to sort of having a data flywheel, especially when you deal with like a look through portfolio, et cetera. So that was why we did it. Also, I'll just mention that this is well known, but of course, if you think about the skew in venture, smaller funds tend to have, if you're in the top decile of small funds, they're usually small funds that are in the top decile because of the convexity of venture. And so that we think is a really good strategy. The issue is that the return dispersion is very high. And so you need to really be able to select very, very well.
Yeah.
And so we felt that there was an arbitrage, or at least an informational advantage to be had using data to select in that particular market, versus seed companies. It's sort of very difficult to develop a systematic sort of data edge, because it's just the nature of uncertainty there.
Got it. So we cover much more in depth later on in the podcast, but I want to know right now from you, how has your journey been at Level, and maybe from an emotional side?
Yeah, emotional side. It's a lot of emotions. So it's been amazing. We've learned a lot along the way. We first started this. We were income from the fund of funds world, and of course there's a lot of learning. It's a steep learning curve. I think it's been very exciting to develop this sort of large scale data infrastructure in this particular market. There's a lot of challenges. We're not going to get to all of them in this call, but you can imagine it's a very data noisy environment. You're talking about disparate data sets that come in at different sort of rates of time. where you have to match entities and normalize time series in an area that just historically is kind of sparse and difficult to do. So that's been like a huge challenge.
Mhm.
There's also a lot of like algorithmic challenges as well in trying to model this particular environment because of the sparsity of return data and things like that. And so it's been a lot of fun in just solving these sort of large scale problems. And over time, we built some so interesting products and systems that we think have a lot of value in the long run and have data flywheels. So that's been emotionally fun and challenging. We also, I think as the market, we'll probably talk about this as well, but as the market has evolved and capital is consolidated in large multi-stage firms, and like the middle is kind of hollowed out a bit, and there's really just the fragmented seed firms and maybe the big, sort of big firms. I think because of that, we feel like our advantage and our preview is very interesting, especially for our LPs, because selection is quite hard and not necessarily track record specific or dependent. And so I think that's been interesting, just kind of developing that platform. And yeah, I think also building a technology and a tech team as a startup, as we're building a firm and a fund and raising capital and deploying capital, I think is it's challenging, more challenging than my prior startups. And so you're balancing a lot of different sort of skill sets. And so I think all that has been really challenging and fun, and we have a lot more to do.
I can imagine that. And how has the LP reception been for fund of fund like yours?
So, it depends on the audience. Generally speaking, as in anything in life, I think the reception has been really good, especially there's certain groups that it really resonates with, of course, wealth managers, multifamily offices, family offices that are maybe less institutionalized. Those kinds of groups, it's really appealing because it solves a problem for them, a deep problem. We're just now starting. We've gotten our first institutions, but it's sort of taken us a while to get there. I mean, I think some either don't have a mandate for fund of funds, which I think that's understood, and others, are looking for a way to get a foothold into the market as a starting point. Fund of funds make a lot of sense, and so we're just learning as we go on what works for what LPs. But generally speaking, we've come very far. Given that we were a new fund of funds in Fund One, we've raised a good amount in Fund Two. And so I think the strategy itself and the technique and the systematic approach has definitely resonated.
Awesome. Good to hear.
Yeah,
So
definitely.
let's shift for this next section and zoom out a bit. So I want to talk about this whole venture landscape and the fund of fund model. And it would be perfect segue towards you were just mentioning that fund of fund might be suited for some kind of LPs, but not for others. So maybe you can take a step back and explain how this whole fund of fund model has evolved in the US in the last 5 years. I know it's a very loaded question, so take your time.
Because I haven't been in this business for very long, but I can tell you sort of what we believe, and I think a lot of it has to do with the various asset classes. I think if you think about the capital line, what's interesting about venture versus other asset classes is that there's an asymmetry and skew of returns, and there's a lot of return dispersion, right?
Mhm.
And I think that makes a huge difference when it comes to fund of funds, because the idea of a fund of fund is to enable selection, not just access but selection. And so if you're from a portfolio perspective and from a statistical perspective, if you're selecting from let's say top half or top quartile funds, you're statistically speaking going to get several hits, and your performance should be, we have some blog posts and whatnot on the website, but your performance should be top quartile, if you select relatively well, not to mention if you select really well, even with the double layer of fees. So I think ventures, I just want to mention that it's a different asset class than, let's say, private equity, or we're talking about hedge funds, where I think it's more of an access play and it's not necessarily maybe as valuable. And so I think that's sort of one piece of it that's important. And I think the other kind of thing I think is important is that it's very difficult. So underwriting is a full-time job. Underwriting GPs is a full-time sport. It requires, a lot of work. You need to have, sort of a lot of networks to look at. A lot of back channeling. Is a lot of quantitative work in our case. So I don't think it's something that, historically, I think a lot of family offices and others have done it part-time and not full-time, and they're allocating to many things at once when it comes to GP selection. But I think in this particular market that we're in, it requires a full contact sport. And so if you have a systematic approach to it, I think that even enables and enhances it. So I think the decision criteria for LPs is whether they have the resources internally to dedicate to sort of investing in this part of the market, especially emerging funds, or
Okay.
whether it's better to outsource that to someone who does it full time, and what the performance differences will be. So that, anyways, that's kind of what we've learned.
Okay. And if you take a look back 2, 3 years, the fund of fund market, has it expanded? Do you see more fund of funds coming online? Do you see more demand of fund of fund model from the GP side as well as from the LP side? And second question is, within the family office context you mentioned, there are a lot of family offices who actually are going direct. They favor direct investing, or at least they are trying to do much more. So how do you evaluate the fund of fund structure in this kind of new paradigm?
Yeah. So I think on the first set of questions, so GPs definitely love fund of funds, right? I mean, they love any investor, but they certainly love fund of funds because fund of funds definitely provide a signal for the market. I think also industry, all the various fund of funds, there aren't that many that are just purely focused on emerging VC funds. So the ones
Mhm.
that are out there definitely provide a signal for the market,
Okay.
and to other LPs and other endowment institutions, et cetera. So I think GPs definitely like them and want them around the table, and they tend to be longer term capital, et cetera. So I think that's kind of like a key thing on the LP side. I wouldn't say that demand has increased for fund of funds per se. I think there's a part of the market that wants to leverage, and allocators that want to leverage fund of funds in areas where they don't have access or the resources to underwrite. And for that, I think fund of funds serve a need, and I think that oscillates over time. I don't think this is like a growing market per se, because you can just tell by how hard it is to raise a fund of funds, right? So, I don't think it's something that's growing in terms of interest, but it definitely serves a purpose for a very specific set of investors, which is actually a very large set of them. So that's what I would say. I would say there.
Okay. And for the second question, the family office bucket trying to do direct investments, what do
Yeah.
you have any thoughts?
Yeah, I think like with family office, they're all different in their own way. Depending on how institutionalized they are. I think in the prior cycle, during like the ZERP cycle, there was a lot of LP capital flows, and I think this market, of course, is very LP capital sensitive. And so I think there was in this prior cycle, there was a lot of LP capital flows from a lot of different groups, including family offices and even retail investors and whatnot. I think a lot of them, the market itself, there hasn't been a lot of liquidity. A lot of them were sort of burned from that prior cycle. And so a lot of I've either bailed out of the market or said, look, it's better I don't do it, and let me sort of work with fund the funds, or just focus on one or two established managers. Kind of like what that's the dynamics that we've seen in market. There's also the fact that geographically speaking, LPs that are outside of the U.S. that are trying to get exposure into the U.S. more so like fund of funds platforms,
Yeah.
in this part of the market, especially if they have an allocation that's out for this kind of investment. So that we've seen in Europe, we've seen it in Latin America, et cetera.
Okay. And do you think access is a really big point in the VC market? For example, what I heard recently is there was an LP who tried to reach out to a fund of fund and tried to ask what funds are you invested in, and then tried to invest directly in those funds.
Yeah, yeah. So we're very open and transparent. Generally speaking, we
Okay.
collaborate with a lot of LPs, ones that invest in us, ones that don't. We tend to be like an open architecture. Generally speaking, I think that pays off in the long run.
Okay.
Access, I think, is there are funds that are capacity constrained for sure. Like we've invested in several that they're $30-40 million funds. We're a $9 million position. There's another fund of funds at an institution. There's just not a lot of space, and they move really fast. So I think that's like one part of the market for sure. Then there's another part of the market which is there's so many of them, and it's hard to underwrite. And so it no longer is an access problem;
Yeah.
it's a selection problem. And I think that is another part of our portfolio, which is like where we think we have an insight into the market, and we think we can get a fund closed and capital form for the fund, and then move on to other opportunities. So, but yeah, I wouldn't say that there are a lot of capacity constrained opportunities, but they do definitely exist.
Got it. I want to move to the third portion of our discussion, and I think this is the main crux because you're so data focused and research focused person. So, what's the role of data, and why is data becoming so critical, at least in the VC space? We have known that venture hasn't been super transparent with respect to any kind of data, whether it's returns data or startup related data. There are different tools, there are different databases. Nobody has the entire ecosystem covered somehow. So why is data becoming so critical now, according to you?
Yeah, I think it's a function of as markets. There's I think a couple of things happening at the same time. I think as markets mature, the nature of alpha evolves and changes. Every party needs to adapt and restructure depending on how the markets evolve. And in these markets today, where there's a lot of capital and a lot of competition, there has to be new techniques and new ways of getting sort of alpha, right? And alpha and arbitrage. One of those could be informational data sort of arbitrage advantages, right? There are certainly network advantages and knowledge advantages, but there could also be very deep data advantages.
Mhm.
And so I think it's normal as these markets evolve and institutionalize that every single piece of alpha that could be had is sort of eked out of the market, and data is a part of that story. I think generally speaking. The other thing is that there has been a lot more data added to the world, both in the private markets with your traditional data, like your Morningstar, PitchBook kind of data sources.
Mhm.
Also, LLMs, generally speaking, have unlocked the ability to sort of digest, understand natural language, and so that opens up, and a lot of the work that GPs do really is focused around analytical work, research work, those kinds of workflows, and I think that opens up the ability to actually now ingest those data sets and make those processes more efficient to some degree. And so that's like been another tailwind for this space. And then as like these larger platforms have emerged, they're just creating these large data moats with all the exhaust. And so I think there's a need to be able to use those for better intelligence, better reporting, better transparency, et cetera, et cetera. So I think all those things together sort of have created this data lens. Although I would still say that a lot of the market doesn't use data at all. So I think we're very rare in that case. And
Sure.
there's a lot of big firms that use it, but there's just like the market is not as data driven as it appears to be from the external view.
So what you mentioned right now, just try to apply this to within your fund of fund approach and what we discussed really in the beginning of this podcast, and try to explain to us what exactly is your um, advantage or your skill or your unique point with respect to the systems that you have built internally and how you're utilizing them.
So we should probably do a demo at some point. I think it's always helpful to do a demo. But yeah, so
Yeah.
our approach is like I said, focused around networks. And
Mhm.
so what we do a couple of things. One is we ingest multiple disparate data sources, including our own proprietary data across the market. And so there's an objective of normalizing the actual investments themselves, per investor. So the actual transactional data, the statement of investments per investor. And so there's a lot of work on doing that. That in itself is a whole project. We have to understand the companies, we have to understand the rounds, the financings, et cetera. There's also the work that we do around benchmarking. So we benchmark the whole industry and we sub-segment it because we don't use like Cambridge benchmarks or PitchBook benchmarks at all. We develop our own. And so whenever we're comparing a manager, we're comparing them against our own benchmarks.
Got it.
Within that segment. That's sort of like a big piece of what we do. We also organize all the companies in the space and we categorize them into verticals and into very specific niches and trends. And that gives us a sense for what's happening, but also where's a manager exposed and where they have expertise and those kinds of things. The big part of what we do is the reconstruction of the talent and investor networks. So the investor networks is really a function of looking at the transactional data and reconstructing the flows of information that happen between investors, which is a function of the syndicates and the stages. And so what the implication there is that that earlier investors create signal for later investors. And to the extent that that happens at a high frequency or at a recency that makes sense, and other features that we've developed, then there's something to be said about the manager that's creating the signal. So that's sort of part of our modeling work.
Okay.
And then on the talent axis, we have a bunch of features that are focused around the founders that the GP is investing in, where they're coming from, the quality of the talent, how much experience they have, how much expertise. All those things go into a larger this graph neural network model that we built that give us essentially it outputs a score of a manager, which is a prediction of their potential top decile performance hit rate. So that's I'm trying to give it to you at a very high level, but that's sort of how the systems work. There's a few other workflows that I can tell you about as well that are not just investor based. So company analysis. So since we're collecting so much data from across the market, both structured and unstructured, we're able to understand the various progress that a company is making from various points of view. Mm-hmm. And so that gives us a sense for momentum or other things that we should know about companies in the underlying portfolios, which I think is unique to us. We also extract trends from all of the data that we're collecting, including like news articles and podcasts and things that we're reviewing on a regular basis. And that gives us a sense for areas that are emerging, the emerging technology areas that are not yet mainstream, and give us a viewpoint on those for thesis development. And then finally, one thing that we've done that we've given to managers is a network tool, which essentially what we do is we are able to search in a very high level of definition for specific skill sets or expertise or experiences, et cetera, of the market, but specifically of your own network, your team's network, and get back very interesting results that you can use for diligence, for supporting your portfolio, et cetera, for sourcing. And that is a huge accelerant for getting things done. So that's just a couple of things that I can tell you about.
Albert probably touched on this, but the high level order, the thing that we do is try to collect data sets at both scale and a quality level that we think is sufficient to make informed decisions. And we try to entity resolve all those data sets into a singular surface area. So you can see for a given company, the private market funding rounds, if it's exited, the exit dynamics. For an investor, you can see kind of their whole portfolio. And specifically for people, you can see everything from where they work to the GitHub contributions they've made to the scientific publications, perhaps that they've published, everything down to even NPM and PyPy downloads is all in the data set and entity resolved, so you can really see everything via a singular surface area. The scale of the data set is quite vast, as you can see. And really one of the ways that we try to guarantee quality is via entity resolution. We try to corroborate data points and via kind of these voting mechanisms, surface and aggregate the data in a way that ensures quality and kind of convergence between various data sets and data points. So that's the first order problem. We've spent a lot of effort on that. And then from there, we try to figure out how to leverage the data points for alpha in our investment strategies. As you know, we try to invest primarily in emerging pre-seed, seed stage managers. And specifically for that subset, performance of those managers is quite non-persistent. Even at year 3, we have studies internally and externally that demonstrate this. At year 3 of an existing portfolio, a top quartile portfolio has a tendency to be top quartile at the end of its maturity, only 50% of the time. So meaning if you're diligencing a fund that is 3 years old and they advertise it as top quartile, there's only a 50% chance that by the time that portfolio matures all the way, it'll still be top quartile. And so one of the things in core kind of methodologies that we use at Level is thinking about things from a network perspective. And so we've built modeling around that, and we've built dashboards internally to help display both the modeling, which is probably one of the more important things that we do, and then also various kind of qualitative and analytics to support kind of different dynamics and questions we might have about the manager. So here's a manager that's in both our Fund 1 and Fund 2, Essence VC. Very quickly, you see kind of the score of the manager. The score is again, back-tested, trained on historical data, and it particularly looks at the networks and the co-investment relationships and the follow-on relationships that this manager has. We'll talk about that in a moment. But what you can think about is that this manager gets scored against all the active firms, the pre-seed only firms, the pre-seed include firms, and also we score all the angels comparatively, of which Essence obviously is not in that peer set. We have various kind of analytics on the homepage that allow us to see how their score might have changed over time and just validate some of the highest order data points that we might have. Maybe just jumping around, you can see various different modules to show kind of the bias of the portfolio, where they've had success in the past and what domains kind of they've doubled down onto. You can see the types of talents and archetypes within the portfolio, and we compare that against different peer sets that we think are reasonable. Like how does the archetype distribution within a portfolio compare to the top investors in the platform and whatnot. And we have various other modules for assessing quality of the teams within the portfolio. Another thing that we really try to double down into is pricing power. So because we've built all these data primitives on top of our data set, um, of which most of those are around like labels of what a company actually does, and then many are around inferring for a private market funding round. Is it a pre-seed? Is it a seed? Is it a Series A? And there's actually a lot of like gaps there that we have to figure out. Anyway, from that, we can really build these modules in a way that's quite intuitive. So if you just kind of look at like Essence VC's seed and pre-seed distribution, you can see for a given investment, we compare the post money that Essence paid against all of the other investments in that peer set, which basically are the same investment type, same vintage year, and same kind of like high level category in terms of what the company does. So like AI companies would be compared against AI companies, biotech companies would be compared against biotech companies, seed deal biotech 2021 companies are, the post money that Essence paid for that deal are going to be compared against all the seed 2021 biotech companies. And so you get a percentile and you can see kind of in this histogram, their kind of pricing power. We do a lot of other things around graduation rates. But again, one of the kind of like the meat and potatoes of the investor strategy is certainly kind of how we model and built up the investment network. So let me just show you an example of what the model sees under the hood. So there's a relationship between Essence Ventures and Redpoint, and you can see these are kind of the deals that the two have participated in together. Anyone, I think, could calculate this, but from those deals, we've enriched this network of features, which derive from kind of the amount of people in that syndicate, the success of the companies, the stage that they invested in. If they're co-investing pre-seed or seed, is a different kind of relationship than if they're co-investing at the Series A or Series B stage. And so when you open this up, you can start to see what relationships are most important for each investor. And of course, YC is quite important for both of them. And so, you can start to sort of see like what we think of as clicks emerge. So Essence is in this kind of like Redpoint, Sequoia Capital, GV, A16Z, SV Angel, Lightspeed, YC kind of click, where those kind of union of investors are both important for Redpoint and important for Essence. And again, that was derived from the modeling itself. And so you can start to kind of rationalize what these neural networks are doing under the hood when it comes to ranking, Redpoint and Essence. And again, these are in a large way black boxes, but these diagnostic tools will at least allow us to like tease out key features that we feel confident in. And then it also, of course, kicks off the qualitative process. If we know that there's a relationship that's particularly important for a given manager in terms of its ranking, we can go and try to validate how realistic is that, relationship in terms of persisting in the future. Will strategy drift for either or of the managers lead to a drift apart? And we'll try to kind of get confidence qualitatively in the relationships that we think are most important for a given investor. There's plenty of other tools, but what I'll do is I'll show you one other thing that we use that's more recently developed called level search. So because we've built up this very strong data set of entity result across all these different data sources, we think we have a view of any particular human being that is maybe kind of like higher quality from a data perspective than any other kind of people relationship management software that exists in the world today. We've layered also on top of those data sets primitives that we believe no one else has. We've built these expertise descriptions. We've built work descriptions. Just to give you an example, the work descriptions don't just describe what a person does at a given company. It actually describes their function. So an engineer at SpaceX has a different function than an engineer at Uber, most likely. And because we have deep kind of descriptions of what the companies do at a very large scale, we can really try to infer the function and the kind of the contribution that a person made. We further have, valuation deltas. Let me kind of pick someone outside of our team. So, for instance, this person, is this Oliver? Yeah, this is Oliver who's on our team. Let's pick someone else. So this is, a manager, and they were a partner at a certain company when the valuation of the company grew significantly. And so we've added in all these primitives into these descriptive fields, and then built this tool to allow for very open-ended searches to come back with very high quality answers. So find me experts in drone technologies. You can ask that. And this search specifically will be on top of my personal relationships, Albert and Jake's personal relationships, and we can expand that to other managers within the network. So this is just an example of one of the tools that we offer to our managers as value add. Because we think that as we build a pool of users in our portfolio who are on top of this platform, they can share with each other networks and kind of expand their, the surface area of the people that they can source via this tool because of that. So, for instance, I asked it, find me experts in drone technologies. This is an example of someone who's a board member at various drone companies. This person co-founded Amazon Prime Air, right? And, you can really then export this list and find these, reach out to these 95 or so people, or find kind of maybe a more reduced list to begin to diligence a particular opportunity. This tool works for, again, an open-ended amount of queries. So you can ask it to source, investors at a given stage. You can ask it to find operators that perhaps you can sell products to, and you can use it also for hiring use cases, of which we've seen all of these use cases used by our portfolio. So anyway, just wanted to give you this very quick demonstration of some of the tools that we have.
Awesome. I mean, it's so elaborate that you have built different modules, and you have different modules acting on different problems per se, if for the lack of a better word here within the ecosystem. Let's take a step back. So you recently published an article, "This is not your mother's Alfa," and in which you cover different segments of return or areas and compared it to public markets. So if you have to evaluate what you're doing with respect to this article, how would you do that?
Yeah, so I think the article touched on a couple of things, at least what we believe about the market today.
Mhm.
So maybe I'll just highlight those, and then I can talk about how we approach it. So the first thing that we believe is that the market is bifurcating into two types of investors. One is called smart beta, and there we're talking about the multi-stage firms mostly, because they have 70 or more percent of the capital goes to those firms.
Mhm.
They have multiple strategies. I think their business is about deploying capital at large amounts of capital into highly legible opportunities where there's momentum, which I think makes sense for their structure. It's very hard to compete there just because of the resources that they have. And then the other part of the market we think is critical is smart alpha.
Okay.
And smart alpha, there is, you're typically talking about either GPs that are working in overlooked areas that are not legible, right? So they're looking for true alpha, sort of narrative arbitrage, I guess you can call it. It's sort of those kinds of investors, or they have the structural opportunity to invest small amounts into companies, so they're able to get into these deals, or there's some sort of knowledge or network advantage that they have that they can utilize. And those things obviously are dynamic and they change.
Okay.
So that's what we think the market is today. So if you think about the alpha piece of it, there are several ways in which we believe alpha could be created. The ways we think that they are and how we develop our technology are three ways. One is network advantages. So these are essentially having relationships that are both non-redundant and economically viable. So that's like one piece of it. The second piece of it is knowledge advantages. So having specialization or knowledge that is both economically important and non-redundant.
Okay.
Right. And then the third piece is structural advantages, which is more focused around the competitive dynamics, which is a function of fund size and ownership relative to fund size and the ability to get into deals. And I think that is the third piece that together creates at least our view of what alpha is in the market. And so we try to quantify that as much as possible with our data methodologies.
And how much of the market do you see, and what percentage of the market are you able to invest into? So what's your funnel approach? Yeah.
Yeah, we see a lot. I think we see most things that happen. Maybe since we've started the firm, we looked at around 1,500 fund managers since we've started. We've made 30 or so commitments, so that's kind of math.
Okay.
But there's a lot of reasons why we don't do something, including it's not a mandate, not an investment mandate, but that's sort of the market, and it's evolving. It's I think the number of fund ones obviously oscillate pretty deeply in markets, so you're cyclical. But in these last couple quarters, I would say a lot of big, a lot of GPs and sort of principal level, even senior associate level from these large firms are spinning out and creating new firms, which we think is it's an evergreen thing in venture. It'll always happen because of incentives, and we like to capitalize on this.
Okay, but you need to find the right ones. Okay, so let me ask you a couple of questions. So you have all this data. Within this data, what does your data say with respect to timing the venture asset class? Can you time venture?
I think timing generally is very difficult. I think all you can say is you can get a sense for what regime you're in. But because ventures, these are like 10 plus 2 funds, like you write about, you just don't have the structural flexibility to be able to, when capital is there, there's dry powder, it has to be deployed. Otherwise, it erodes in economic value. So even if you knew the right time, there's not much you can do, right? And typically LPs pull out at the wrong times, right? Just because of the nature of these things. And so I think it's hard to time. What we do believe though is you could time to some degree the thematic areas that you're investing in.
It was my next question.
Yeah, we do believe that you can do that. I think it's the way we think about it is that there are parts of the market at any point in time which are innovating at a high rate, but yet do not have a criticality moment such that there's a narrative that's developed. There's a capital rotation. So to give an example, we were in our first fund, we were investing in like defense and industrial kind of real like physical world technologies before there was kind of a capital rotation into that space, right? So it's not to say that no one's thinking about it. That's mostly insiders are thinking about it, and the market is avoiding it, usually because of some counter narrative like, oh, hardware is hard or something like that, or we don't like these capital intensive businesses, or we don't want to create missiles for defense or whatever it is. And so we believe that you can actually move capital away from areas that we think are maybe at the end of a saturation cycle, like I don't know, maybe fintech back then, and then into areas where there's an undersupply of downstream capital. And so I think that is more time, but the underlying timing of the cycle itself, the economic cycle, I think is very difficult to time. All you can say is, I think we're in a bubble, but that doesn't mean it doesn't help you in any other way.
So we can more talk about the regime itself rather than saying timing of the markets, and thematic investing is much more kind of, I wouldn't say easier to do, but much more pragmatic to do. Within this whole ecosystem of investing, what do you have to say about like how much is it driven by the logics, by data, and how much is non-data driven decisions within your fund of fund?
I don't know if there's an exact percentage. I think there's a balance between the two, and maybe it's a spectrum and a continuum depending on the situation. I think having a data lens gives you at least an objective point of view. It also gives you a common language with your team on what to look for. And I think that's very, very helpful. It also helps you filter the world and focus on what not to focus on, which I think is important. I think nothing replaces, sort of face-to-face instinctual, chemistry with people. And sort of understand and try to unpack the integrity of people. I think that we really double down on, and we do that both face to face, but with a lot of back channeling and front channeling and all that sort of stuff. So yeah, I don't think this is a business where it will be replaced by machines, in the near term. But there are a lot of advantages to seeing things that maybe others don't see, and so that's what we're trying to capitalize on as well.
Albert, recently you published an article about the MCP and how different modules are integrating and powering this MCP and trying to revolutionize what is happening in venture. It was supposed to be one of the groundbreaking moments within venture and still went undercover, but explain to us all about it.
Yes. So we launched one of the first remote MCP services, which essentially an MCP is a model context protocol. It allows LLMs, like your foundation models, to interact with external services. And they're done in a way that you can sort of create context and the agent knows when to use the resources. And we developed an MCP with a lot of sub resources that allow our team today to, as they're doing LLM searching and sort of exploration, it integrates our data, our large scale data very seamlessly. And so we believe that over time will be a large part of the kinds of workflows that other VC firms will do with their proprietary data sets. It also enables us to provide the services to others, including our own GPs, as we start refining those services. And so I think there's a combination of empowering, the research analysts or the investors with data at their fingertips as they're looking at specific opportunities by collating all of the data from across the whole ecosystem. And so I think that is a big thing that I think a lot of firms will end up adopting over time. And of course, I think that will limit the amount of people they need and also create more competition.
Okay. So give me an example of how this can be used within a GP. So does MCP, can they replace their research analyst altogether? And then all the due diligence part, or at least the research behind the scene, the thematics, the building of the case and everything can be done by this?
Yeah. So I think the way, at least we think about it, is there's like kind of a two-step process. So if you're, and we use it all the time. So if we're diligencing an opportunity, for example, there's part of it is getting up to speed as soon as possible on the market itself. Who are the competitors? What other great syndicates have backed similar companies? What do the public markets say about these particular things in earnings transcripts? What are the founders, et cetera? So, how does a competitive matrix look like? That work we do through this service. And so it allows us to get up to speed, but in the context of the data that we have, so we can very quickly know what to ask. So that's sort of one very, very big thing that helps us accelerate the timetable on whether opportunity within our philosophy and our framework. That same tool can also generate a set of people and experts in our own network that we should talk to get the secondary level sort of expert guidance on the actual opportunity. So if you accelerate that into a 3 or 4 day process versus a 4 or 5 week process, which is usually sometimes is a 3 or 4 week process to really learn a market, I think it's a big speed advantage. And also it allows you to not miss things, right? And to give you a more holistic understanding of what you're looking at. And I think those things create better outcomes.
Yeah, definitely. It's more than efficiency. It's about being accurate as well. So so you explained a lot about data, but you also talk a lot about the public data. So do you think the public and the private markets are kind of converging?
I think that there's convergence happening for sure. I think especially as you just think about it, as companies stay private longer and there's a more active later stage secondary market, right? And a lot of the companies are actually much larger than a lot of the small cap companies. Yeah. And so there's this notion of both happening, like the growth market and public being very similar. In some degrees, just one being more illiquid, or having less volume. So I think there's that happening as well. I think also the public markets are impacted by innovation happening in the private markets and sort of the narratives that develop in the private markets very deeply. And so there's sort of a investor narrative approach to this as well. So I think that's happening also. I think the public markets are getting a lot more passive, generally speaking, right? I think 60 or 70% is just sort of passive holders of equities. And so there's not a lot of active necessarily management, let's say in the public markets. I think there's a lot of dynamics that are happening that there's definitely some crossover between the two. And I think a lot of we've done our own analysis, but a lot of the really good active investors in the public markets actually are crossover investors, which I think is an important kind of insight when you think about it, because they're leveraging a lot of their insight from the private markets in their public market decisions. So I think yes. And the long short answer is yes.
I would 100% agree to it. So the way I see the market as well. Last question for you. What's next for Level?
Yeah, so we have a lot to do already with kind of what's on our plate. There's a lot of technology development that we want to do. We want to refine these tools, have more of a data flywheel, and really have the most sophisticated data set in the market. So there's a lot of technical stuff that we're doing. We want to be the best emerging VC fund-of-funds. There's a lot of work to do there to both invest as well as add value. We want to expand our co-investment arm, and then we feel like we can develop a set of other investment products, maybe even a crossover product eventually, that could be very unique for investors from a holistic perspective. And so if we can be the best quantitative investor in the private markets, I think that'll be like the amazing accomplishment.
Wow. Albert, let's leave with that. You want to be the best quantitative private markets investor. Thank you so much for joining it, Albert.
Thank you so much
for taking the time.
Thank you, Rohit.